Dear audience, after this short break, we continue today's program with another panel discussion titled Geopolitical and Economic Fragmentation Risks, Shifting Linkages and Financial Stability. Before the discussion starts, I asked Mr. Stefan Thurner, President at the Complexity Science Hub Vienna and full professor for Science of Complex System at the Medical University Vienna, to deliver his keynote presentation on this topic, and afterwards to please take a seat on the stage. Please welcome Mr. Thurner.
Thank you very much for the invitation. Quite an honor, quite a pleasure. Thank you. I would like to use the next 20 minutes to discuss a little bit if we have to if we should rethink our view of systemic risks, systemic financial risks, if we know supply chains. Supply chains and turbulent times go together very well. So that's the topic of the next couple of minutes. The team includes people from the Hungarian Central Bank, so it's a great, great pleasure to present this work here. András Bosos is even here. Yeah. Supply chains become more and more visible. If we see the supply chains at the firm level, then we basically see the atoms of the economy. Why is the firm level a good scale to look at? Why not industry sectors? Why not regions? Why not products? The firm level is the level where the economic decisions, or most of the economic decisions, are taken place. What is produced? Who is hired? Who are the suppliers, etc. These decisions are made on the firm level, on a firm scale. So if we see supply chains, meaning the firms and their suppliers and their customers, then we basically see the flow of goods, flow of products, flow of work, flow of whatever. We see the physical substrate of the economy. We don't necessarily see the financial part of it, but I come to that. And that's something super exciting, to see a metabolism of something. This is new. What could this new view help us with? We could, for the first time, check if our markets are really allocating resources optimally, or how optimal they do that. We could re-evaluate the question, or we could reopen the question, if planning economies would be more optimal in whatever sense than where markets lead us. We see where the prices form. If we see things happening at the firm level, we see where the prices are made. We see where the inflation comes from, for example. And of course, we would see exactly where in a region, where in a firm, where wealth is created and how it's distributed. So this is a really new possibilities. And the topic of the next minutes, we can see systemic risks. And we can calculate systemic risks. We can, for the first time, compute resilience of systems. So, and we all know in economics we typically have to work with the aggregates of what I just said. We have to think of aggregates of banks, industrial sectors, buyers, consumers, etc. If you have never seen an economy, here is the Hungarian economy. This is about 100,000 firms. The size of these firms is the annual turnover, and it's about 1 million links that you see. That's individual firm-to-firm supply relations. If you zoom into this, you can really see the dots are the firms, and you see little arrows. The little arrows show you who pays value-added tax, which firm pays value-added tax, and how much to which other firm. That creates a picture of the legal part of the economy. This is similar situation for the economy of Ecuador. This is I think the 10 or 20,000 most biggest firms in Ecuador, and What is important here, the colors is the industry sectors. You see how incredibly interwoven this economy is. And what's also important is these economies are never static. 10% of all the firms go into existence, 10% more or less go out of existence, and hundreds of thousands supplier links are created and destroyed over a year. So to get these dynamics right, sooner or later, we're far from understanding this, but will maybe lead to a new paradigm of how to see and how to deal with economies. So economies are constantly changing. We have to understand the dynamics. If we see these networks, this is not an economy yet. I was lying to you. This is only a part of it. This is only the structural backbone of it. To arrive at the model, at an atomistic model of an economy, we need a couple of ingredients. One is the structural backbone. That's the supply chains. That's the thing I've shown you. The next thing is we have to know what these firms are doing, how they are combining their inputs to produce an output. We have to know their production functions. We have to estimate them if we don't know them. Then we have to have a feeling of what firms are doing if certain suppliers are getting out of business or are no longer available or are no longer shipping to a firm. And of course, we should know how prices form in the different markets on the firm level, since most things are not traded on markets, it's OTC, so it's a very complicated problem. So these are the ingredients. If we can tackle those, we can do new types of models. So I'll show you how we are dealing with these ingredients, how we're putting them together. So let's start with the supply chains again. A buyer buys a product from a supplier. The supplier ships the product, that's the W, and the buyer pays the price, that's the V, plus a tax. And the tax is recorded from this. We reconstruct the network that you see on the right. And every node in that network has a production function. So the node 6 is getting products, inputs from firm 2, 4, and 7. And it's indicated in this formula. It combines these inputs according to the technical coefficients and produces an output that it sells to firm number 8. Okay, that's basically what these networks are telling us. If you don't have value-added tax data, which most countries don't have, Hungary is in the privileged position, or the Hungarian central bank is in the privileged position to have it. There's other options, from payment flows, which other countries like Mexico, Brazil, in Europe, I'm not familiar that we would have payment flows on firm-to-firm level. Bank-to-bank, yes, but firm-to-firm, no. From communication flows, firms that talk to each other have supply relations that can be studied very nicely. Very tediously, you can combine company information. That's what supply chain management institutions have been doing for decades. It's getting more and more better. You can use historical internet data to try to reconstruct firm-to-firm relations from the history of the internet. And yeah. Second thing is production functions. You all know that there's different types of production functions. A baker has a different production function than a wholesaler. So there's Leontief production functions, there's linear production functions, and Cobb-Douglas, and academics like us use usually Cobb-Douglas production functions that were introduced for very specific purposes 100 years ago. Maybe not super realistic. A mix of Leontief and linear production function is what is 99% of the time taking place. This is the function that we are trying to fit from the data, from the Hungarian central bank data, for every company. This is the output xi, output of firm I, is a function of the inputs, and the inputs are given by matrices like this capital pi. There's labor and capital to the very right. There's a couple of minima, very nonlinear thing. I don't bore you with the details. Just how do we get these coefficients from? No, I don't bore you with the details. The third ingredient is that we need somehow a notion of how easy is it to replace a company that fails to supply something. So if a supplier drops out, how easy can I substitute for that loss? We just assume, don't look at the equation, we just assume that if a firm has a high market share, it's hard to replace such a firm. If the market share of a firm is very low, if many companies produce the same goods, it's easy to substitute. So in this we try to quantify in a number, and that number will flow into something I'll show you later. And if you have these three ingredients, you can already perform a very simplistic, very technocratic one-to-one agent-based model, a model where every firm in a country is represented by an agent. The agent has a balance sheet, and you have the flows between these agents. So there's a lot of things that you can address, lots of economic questions you can address with such models. I want to just pick out to quantify resilience and identify systemic risks. So let's talk about systemic risks. What is a systemic risk of a company? We tried to come up with a number for every company that tells you if you take that company for whatever reason out of the economy, how much would the total production of a country or a region go down? So how much does the GDP go down if I take out one single company? Usually it's nothing. Sometimes if you take out the atomic power plant, that might be bigger effect. Yeah? That's our systemic risk measure. Economic Systemic Risk Index, we call this ESRI. Yeah, very unsexy name. That's it. I don't bore you with the algorithms behind it. It's just important to note that what we are doing is we are really taking out the firm off the network. We know the production functions, then we go down. What would happen to the customers of that company, and what goes up? What would happen to the suppliers of this company? They all have to reshape and rearrange their productions. So, and the algorithm at the end computes what is the result of that failure. Up and downstream propagation of risks is different. You have to take this into account. You have to take into account the substitutability. That was the sigma that I showed you before. It appears somewhere here. And then we compute this economic systemic risk index for every company in Hungary, for example. So this, you see this number on the left-hand side. It's all the 100,000 companies ranked. The first 23 companies are sitting on a plateau of 23%. Means one of these 23, if you take one of these 23 companies out, the GDP would drop by immediately by 23% if no interventions take place, and if nothing else takes place. So this is unrealistic, will never happen in reality, but this is if nothing would happen. Is this the big companies? Yes, it's of course, it includes a couple of the big companies, but there is also very small ones included. That you see on the right-hand side, the red dots are the super systemically risk firms. Some of them are very small. Some are very big, some are tiny. So this is the 23 companies. They are all connected to each other. They form a systemic core. This is a metastructure. It's not a microstructure, it's not a macrostructure, it's a metastructure. It's a dependency network. If you kill one of them, the whole thing collapses. And that's why they all have more or less the same systemic risk, because they lead to a cascade of damage in in the most vulnerable part of the economy. Okay, if we know all this, if you believe me, then we can go on. What does this mean now in a financial context? Again, the Hungarian Central Bank has this fantastic situation that they have the firm loans. So we have three things. We have the supply chain, the real economy, then the firm loans link it to the financial sector, and Hungary, the central bank, of course, also has the interbank exposures. So you see the whole thing for the first time, how the financial sector is coupled to the real economy. And now look on the left-hand side. The shaded area indicates the supply chain level, the firm level. There's it's hard to see, but there's another layer, that's the financial layer. So firm F collapses. Firm F has and can no longer repay its loan to 3, bank number 3. Bank is in the bank. The numbers are the banks 1, 2, 3, 4 in the financial layer, and firm F no longer repays its loan. But F also no longer supplies to D. D might be driven into default because it can no longer produce something, because it's in trouble. It cannot substitute F, so it will also not repay loans anymore now to firm number 4, to bank number 4 and 3. They will suffer indirect losses, financial losses, credit defaults. So this we try to pick up into these charts to the right, where we distinguish between direct losses, if a bank collapses, direct financial loss, and direct economic loss. The indirect losses are also indirect economic losses. Another firm can no longer produce or has to produce less, and might also create financial losses. It might leverage and inflate the credit losses. Okay, so here I summarize the data sets that we are using together with researchers from the Hungarian Central Bank. It's the value of the tax data. It's the balance sheets and income statements of firms. It's the loans to banks, the bank firm loans, and equity positions of banks. So it's 240,000 firms for the year 2019, 27 banks, million supply links, and about 25,000 firm loans. So again, I don't bore you. We have these variables from the balance sheets, and with these we can do very much the same as before. We now ask, what happens, what financial losses do I create if I take out a company? So the direct credit defaults are clear, but what's the indirect effects? So we compute the sister indicator F3, financial systemic risk indicator, and do the exercise, compute it for all the 100,000 firms or 240,000 firms now, and we get this blue curve. Again, we see we can do financial damage. If you take out one of these companies, you see substantial equity losses to the banking sectors of up to 15%. We can also turn it around. We can ask what happens to the firms? Here we have the same, or more or less the same, it's the same indicator, but now for the top 80 companies in the country, the colors are the different banks which would suffer this and that much. So you can get really a very easy overview. Now, Hungarian data is even more fascinating than this. They can see how many employees work month by month for which firm. So for the COVID, to do something realistic or more realistic than shocking one firm after the other, we computed or we designed a COVID shock. We took the actual employee numbers, how they dropped in the first quarter of 2020, following the COVID shock, and we shock every of these companies according to their employee loss. It's of course not, certainly not super realistic, but in this way we can shock the entire economy in a real scenario. So we're shocking 240,000 firms. Many are not shocked. And then we compute for the banking sector the expected losses, variance at risk, or expected shortfall. That's the different colors for the 27 banks. And we see the direct losses. That's the measures that you would compute by textbook. And then the light colors on top of the bars, this is the indirect effects. And these are huge. These are not 5%, 20% or something. These are factors of 3 to 6, 300 to 600%. Is that reality? No. You have to be careful again, but you have to look and see where these risks are coming from. Some of them might be right. Some of them might be easy to explain through specific outcomes. You can look at the different industry sectors, how they are affected, directly, indirectly. So this, again, gives you a good overview of what happens to the financial sector, what happens to the real economy at the same time, linked to the same credits. And this is my last slide. I'm over time. Just let's look at the left-hand side. On the x-axis, you see the financial problem of a firm following this COVID shock. This is the amount of liquidity that's missing. So the firm has to go bankrupt. The x-axis tells you with this amount you would just not kick it over the edge. The y-axis tells you of how, if you gave that money to the company, how much would you save in losses to the banking sector. And whatever is above the diagonal, so every dot is a firm, whatever is above the diagonal is a clever rescue operation. is a good investment in a total economic view. And on the right-hand side, it's the insolvency, and on the left-hand side, it's the equity. So you can also distinguish between those two things. Okay, I don't summarize. I'm way over time. Thank you for your attention.
Sit. Thank you, Mr. Thurner, for your presentation. Now it is my pleasure to ask Mr. Manuel Ramos-Francia, Director General for the Center for Latin American Monetary Studies, to deliver an introductory presentation and afterwards to moderate the panel on this topic. He will be joined in the discussion by Mr. Stefan Thurner, President of the Complexity Science Hub Vienna, Mr. Carlos Quicazan, Head of Financial Stability at the Central Bank of Colombia, and online by Ms. Mahvash Qureshi, Assistant Director and Chief of the Global Financial Stability Analysis Division of the IMS. Thank you. Yes, sir.
There you go. Yeah. Thank you very much. That was a really nice presentation, Stefan. Precisely, Serafin was telling me during the break, he like to use this, I imagine with you, this type of framework to try to gauge or measure the impact of the loss of ecosystem services. And I think that's a tremendous, tremendous work. So let me give an overview, complementing a little bit what Stefan just mentioned about the impact or the what is being called the geoeconomic fragmentation and financial fragmentation. The impact of geoeconomic fragmentation on the financial system. So the first thing to go, if we go to the first slide, the first thing to understand is that this geoeconomic fragmentation, it's an ongoing multidimensional policy-driven reversal of global economic integration. So what's been going on behind this? Well, we've seen a very important increased skepticism of benefits of global economic integration, not only in advanced societies, but also in less advanced societies. We've seen this type of debate coming from an uneven recovery of the global financial crisis, Brexit, US-China trade tensions, COVID pandemic, military conflicts, and so on. Some of you may adhere also to this view of the famous polycrisis, which is now back in vogue by TUS in 2023, which basically states that there is a coincidence of shock of any sort, economic, geopolitical, climatic, or epidemiological, which is not accidental but cumulative and endogenously self-amplifying. Basically, it says that the sum of the effects of each of these events is the overall impact is bigger than the sum of the individual effects of these events. And how to think very basically about geoeconomic fragmentation before we go even into work as interesting as Stefan's. I think that what first comes to mind, as Stefan's presentation showed in great detail, is immediately what comes to mind is the misallocation of resources. This is the first thing that comes to mind from an economic point of view. And think about this very easily in terms of transiting from a complete markets paradigm to an incomplete markets paradigm. We all know that with a complete markets paradigm, the type of price equilibria that we get from that has very good welfare properties, which are not reflected in an incomplete markets paradigm. The third point that I put there, which is a cooperative versus non-cooperative games equilibrium, basically it's the same point as the first. The first one would only be considering price takers, sort of like how a competitive equilibrium is established. And second is where you have price makers. That is where the individual actors have pricing power. But the result is the same. Basically, you will be getting equilibria, which is certainly has less welfare than if you go into a more complete markets situation. Another point that I also wanted to highlight immediately is that there will be winners and losers. Mostly, and in the aggregate, there will be a lot of losers, at least in the short run and medium terms. But in the short and medium terms, there are some winners too. And the first country that comes into mind very immediately is Mexico, but also other South American economies that have benefited from trade, certainly from trade diversion. Now, at the end of the day, when you try to gauge the overall welfare, let's say global, perhaps there will be no affectation in the long run, but certainly in the short and medium terms, even if you have some of these winners, certainly the global welfare is decreasing. And also, not only will there be winners and losers internationally, but also intranationally, and certainly the better off have much better ways to hedge against this type of situation. So again, even in advanced economies, the better off will certainly be losing less than the worse off. If we go to next, basically these are graphs that you know very well. I'm going to go very briefly. The left one puts the trade restrictions have been increasing, and what is really astonishing here is the pace of the increase. And in the right-hand side, you see that in the context in which trade has plateaued, that as a result, probably not completely as a result, but certainly plays a very important role, this increase in trade restrictions and other kind of restrictions. We see that overall trade has certainly plateaued since the global financial crisis. Now, which are the channels through which geoeconomic fragmentation hit? Also, you know some of these very well. The first one is economic costs. As I was saying, tariffs are passed on partially or wholly to domestic consumers and importers and so on. Basically, what you will see is, for example, many of the things that Stefan was saying, well, it's going to be reflected in prices. Those are the main signals in most of the economies globally in terms of how resources are allocated. And of course, these price signals will certainly have a lot of distortions. The more geoeconomic fragmentation takes place. There will be supply disruptions, as I'm not going to go into that, as Stefan was certainly showed. Second, technology diffusion. This is a crucial part in certainly emerging markets. There's an important way in which emerging markets catch up in terms of technological advancement, which is through trade. I can speak very clearly, for example, in the case of Mexico. And the more there is economic fragmentation, the less, of course, technological diffusion will be in place. Certainly also the pattern of capital flows can be affected. There are some very interesting studies from the recent studies in the IMF that show how capital flows can be affected if geoeconomic fragmentation takes place, measured in some certain way, which is very interesting what the fund has done in that sense. Also, we will have labor movement restrictions again, which can have an important impact in terms of cross-border labor flows, which could reduce efficiency, innovation, and technological diffusion too. And in the case of, for example, Mexico and some Central American and Southern and South American countries, certainly also remittances could be reduced. Public debt, we all know, coming from previous to COVID, from a decade, or more than a decade of unprecedented monetary policy and very low natural rates of interest, we know that indebtedness levels increased dramatically, also the duration of that debt. And of course, if there are any debt problems, defaults and so on, with more geoeconomic fragmentation, it's certainly going to be a lot more difficult to resolve those type of situations. There is certainly increased uncertainty during a possibly prolonged fragmentation process. Now, let me go into more detail very briefly in the sense of the impact on the financial system. We have here 4 groups. Certainly the first one would be bank funding costs. We expect that geoeconomic fragmentation certainly can affect bank profitability and thus the provision of credit, which would be a very important channel. Second, certainly we can think of all types of liquidity risks, liquidity in terms of market liquidity. We would have uneven liquidity conditions, the amplifications of market disruptions, and this type of things that I was talking about in my introductory remarks, and certainly a fragmented global liquidity backstop. There could also be, not difficult to think of, regulatory arbitrage, given the regulatory differences amongst jurisdictions, and also certainly a very important increase in counterparty risks, as we note there. But perhaps one of the most alarming things, and I'm about to finish, would be that in order to fragment the tensions and the conflicts that are behind that fragmentation, of course, they cost. And they take away not only resources, capital, but also time. And that's less resources, both in terms of monetary resources, financial resources, and time resources to really go about the public provision of global goods, which is, I think, in this day and age, crucial. And let me put 4. One would be environmental risks. The second is how to harness artificial intelligence appropriately. Of course, the pandemic and health risks, and certainly also the role of institutions like the International Monetary Fund as an efficient global financial backstop. So instead of focusing on problems, on issues that certainly will probably have a tremendous impact globally, we're busy doing other things, basically getting into conflict and getting into issues which certainly is going to lower our welfare. notwithstanding the impact that these big things that I was commenting about, these big topics, we're going to be putting a lot less attention on them than we should. If we go next, we see here, I could, construct, and most of you and all of you could construct a much more intricate network, but I think that this is sort of like a first layer of connections, of interconnections. We see here some of the main risks that are affecting us globally, and certainly some of these would need a lot more attention, that we should be paying a lot more attention on them instead of going in the direction that we are going. And finally, let me very briefly present to you the results of this World Economic Forum Global Risks Perception Survey. The horizons, the questions included a 2-year horizon and a 10-year horizon. And we can see very interestingly how as time goes by, the transition towards every time more importance given to environmental risks and also to technological risks. And behind these technological risks is, again, the issue of the cost that would probably mean for the, even not exaggerating, for the human race of not harnessing artificial intelligence appropriately. So I just wanted to put these things out there. And now I will be posing some questions to our members of the panel. So thank you very much. Okay, so I have around 3 rounds of questions. The first one has to do with geopolitical tensions and macro financial stability. So let me pose the first question to Stefan here. Considering the emergence of trade blocs amidst geopolitical tensions, how is the changing interconnectedness of major economies affecting trade patterns worldwide, especially for smaller economies that are highly dependent on international trade?
Yeah, certainly, the globalization changed networks a lot over the last 30 years, and you can ask what does this change of networks mean in terms of stability, efficiency, resilience, etc. And I think things are, as always, not easy. During the last 30 years of globalization, networks were spreading across the globe. They were getting bigger. They were getting delocalized. So you could say they would become safer because you're hedging your production. At the same time, production networks get longer and more fuzzy, meaning that that the networks as a whole would become less resilient, more prone to disruptions. So this shows that it's essential. So you cannot say did it get more. It certainly got more efficient, and but did it get more resilient or not? It's very hard to say. It matters on the details. Details matter. How these networks really changed, how firms and banks interact. The details matter, and this is something, that's very exciting on the scientific side, and very problematic on a data side. Where do we have data on global supply chains? Far from there. In the financial world, might be a little bit better, or at least some indicators you can do transnationally. But yeah.
Let me quick follow up. So, but is the appropriate way of thinking of geoeconomic fragmentation, and maybe I misunderstand, but sort of like a trade-off between resiliency and efficiency? But from a global point of view, I don't know whether that trade-off is the one that we should be sort of like focusing on. because a country might very well think, and that's the reason for there to be this fragmentation, that they want their supply chains to be more resilient in the case of the US, less China participation, more Latin America, but certainly there will be a great loss of efficiency. And that's probably the point, right?
That's exactly the point. So efficiency, as efficiency goes up, you're reducing buffers, you're reducing storage, you produce on demand, you're making the supply chains much, much leaner. You're making the network much sparser. Yes. And at the same time, you become less resilient, much less resilient. Yes. But we had lucky times. We didn't face that until very recently.
That's right. Thank you, Stefan. So let me now go on to a question to Mahvash Qureshi. So the geopolitical tensions can have a significant impact on the global financial landscape. How do you think that the current geopolitical tensions may influence cross-border financial integration, particularly capital flows?
So thank you, Manuel, for the question. And first of all, let me thank the organizers for the kind invitation to be part of this panel discussion. My apologies for not being able to make it there in person, but I'm very glad that technology has allowed me to join virtually from DC, this very timely and interesting conference. Moving on to your question, indeed, as you alluded to in your remarks also, geopolitical tensions could have a very significant effect on the global financial landscape. And this could be through the imposition of financial restrictions on cross-border capital flows or on payment systems, but also through increased uncertainty that such restrictions may be imposed in the future, or that geopolitical tensions could escalate. And that may deter investors from investing in rival countries. Now, you mentioned some work that the IMF has done, and indeed at the fund we have been doing quite a bit of work to understand the potential implications of geopolitical tensions, a further rise in them. And some of that work was done from the financial side in one of the IMF's flagship publications, the Global Financial Stability Report that was published last year. And basically looking at data for the last 2 to 3 decades, what we observe there is that geopolitical tensions do tend to affect the cross-border allocation of both credit and investment. Now, how we do that, of course, it's not easy to measure geopolitical tensions, but we use proxies that are conventionally used in the literature, political science literature, for example, where geopolitical relations tend to be captured by the similarity in the foreign policy outlook of countries. And that is typically measured by their voting behavior at the United Nations General Assembly. So if one uses such a measure, for example, what we do see is that countries tend to allocate a much larger share of their portfolio investment, direct investment, banking claims to recipient countries with which they share a similarity in geopolitical views. And a much less share is, of course, allocated to more geopolitically distant countries. Now, this measure is not, one could argue it's not perfect. So we look at some other measures, such as bilateral sanctions between countries or the strength of arms trade between countries. And by and large, what we find is that the same relationship holds across the board. So it's quite a robust finding that we have. Now, that said, the relationship is not, it's not homogeneous across countries. We do find that some macroeconomic characteristics matter, and most notably, the extent of financial development and the extent of external buffers. So, foreign exchange reserves to GDP ratio, NFA to GDP ratio, they both stand out to be quite important variables. And basically, to some extent, countries with a high level of financial development or a higher stock of FX reserves tend to be, face less of an adverse impact. And this could presumably be because investors have greater confidence in these countries that they would be able to better absorb the shock, or because of, for example, greater hedging opportunities available in these countries if they are more financially developed for investors. That said, what's happening, I'll just spend 30 seconds on what is happening at the current juncture. So what we have seen in the last 2 years, and now the data, of course, is limited. It's just 2 years. But the patterns are still really, really striking. And the two things that I would like to flag here. First, we, of course, see a continuation of the trends that were in the past. So if you're more geopolitically distant, you get less allocation and vice versa. But in addition, what we're also seeing is that there has been a change in this allocation. So on average, source countries are allocating more to geopolitically aligned countries and less to geopolitically distant countries. And what that may indicate that if this pattern continues to hold and we get even stronger evidence going forward on this, is that in the bigger scheme of things, it could be that geopolitical factors are becoming more important in recent times, and investors are paying more attention to them in the past. So let me stop here.
Thank you very much. So let me now pose a question to Carlos Quicazan, who works at the Banco de la República in Colombia. I think that's a very interesting case because it's sort of like a bystander. Many countries in Latin America are feeling two very important pools. One, of course, coming from the US as being part of the Americas, and another one coming from China. So in that sense, I think that's an interesting sort of like experiment in the sense of being in the middle of two important forces. So given that in mind, having that in mind, what specific challenges do ongoing geopolitical tensions pose to Colombia's macro-financial stability? And how's the Colombian Central Bank adapting its monitoring tools to assess these risks effectively?
So thank you, Manuel, for your question. Let me start to thank you, the organization, for inviting me to participate in this panel. So Colombia is a small and open economy, and its exposure to global trade is focused on some countries, as the United States, some European countries, and some Latin American countries. So for this reason, the challenges to the financial stability due geopolitical tension are going to depend on the type of shock. For example, the tensions between China and the United States led to capital outflows in Colombia, considering the high aversion risk and the high exposure of Colombian public debt to United States investors. However, this episode was very different to 2022, when the commodity prices increased, and in this sense, increased due to the uncertainty about the duration and the effects of the European conflict. So during this time, some export countries like Colombia were benefit, as you say, Manuel, a couple of minutes ago, were benefit of the high oil prices. And during this period, Latin American received capital inflows in contrast with other emerging economies. And this was given by the geographical distance from the conflict zone. So to assess this type of risk, the central bank improve and create some monitoring tools. For example, the Central Bank of Colombia managed the public debt system or public debt transaction system that allow us to identify the counterparts of each operation of public debt. So in this sense, we know if the counterpart is local or is foreign, and we know the type of counterpart, if it's a pension fund, a hedge fund, monetary funds, among others, and also the location of these investors. So this is very important for us to monitor this type of risk. Also, all financial derivative in Colombia that the underlying asset is a foreign currency must be registered in the central bank. So with this information and with the information of balance sheets of the firms, we can measure the exposure of firms to currency risk. And finally, currently the central bank creates a geopolitical risk group, and the group elaborates a quarterly document where they identify and assess the principal global financial vulnerabilities or geopolitical events that can have an impact in Colombia. So that's the way that we try to monitor this type of risk. Thank you.
Thank you very much. I think we are getting there in time. So let me just pose one more question to Mahvash. I think that the fund is caught. You can think of the fund as being really caught in the middle of all of this. And my question to you would have to do with the global financial safety network. And in that sense, I think that the approach that the fund has had for the last few years, and especially in the last, let's say, 10 years since the global financial crisis, is one of changing a little bit the nature of the facilities that are out there, from more conditional corrective facilities to more preventive, and trying to put better incentives, facilities to improve incentives of good macroeconomic management in countries. Would geoeconomic fragmentation have, do you think, any important changes in the way you design this type of facilities? Has it already have an impact? How do you see let's say, a global financial safety net, which is a lot more fragmented, working in a setup like this? Would there have to be changes and so on? How do you think about this in terms of one of the fund's main functions?
Thank you, Manuel. That's an excellent and very, very important question. And part of the work, one key reason for the work that we have been doing at the fund on trying to understand the implications of fragmentation is to better able to sort of understand and identify how we need to, or if we need to evolve, and how we need to manage these sort of challenging times. And as you pointed out, it may not be easy for institutions like the IMF at the multilateral level. Nevertheless, that said, the IMF has an important role, an extremely important role to play in these circumstances. First of all, I would say the convening power of the fund in terms of bringing together the different, countries, different blocs, factions, whatever you want to call it, and trying to make progress on issues that are of importance, common challenges across the board, and issues that are important or are of importance to all countries. And some examples, the fund has already been doing that and would continue to do that. Examples of that are, for example, on the debt resolution side, you referred to that in your excellent presentation. On the climate side, so that is an area where I feel strengthening or enhancing global cooperation and trying to act as a forum for that. Now, secondly, we have been playing an important role and would continue to do that in terms of policy advice, lending, capacity building. I think the fund toolkit, according to circumstances, and you pointed out, it has evolved over time. There's no point in me sort of speculating in that direction, but we have been lending out to countries, and that's the bread and butter of the fund for external shocks, for example. And as I just mentioned in my earlier remarks, a key risk to countries from a sudden spike in geopolitical tensions is sudden reversal of capital flows, putting pressure on the balance of payments. So that's like a core lending activity of the fund. The other, which you mentioned in your remarks, is that in the medium term, longer term also, one could think of all these limited risk diversification opportunities, and our work shows that that actually holds greater concentration of external exposures, leads to increased macro financial volatility. What that implies is that the probability of tail events could go up, so we could see more, relatively speaking, greater volatility or more incidents of crisis. And again, fund has a very, very important role to play in those circumstances. And so, of course, at the international level, what we need is to ensure that institutions like the fund remain adequately resourced. We also need to ensure that, in totality, the global financial safety net is strengthened. And what that implies is, of course, greater coordination also between the international, regional, and country layers of the financial safety net to ensure that countries have adequate resources in times of need when they are hit by such a shock.
Thank you very much. So I think we'll probably have time only to take one or two questions from the public, if there are any. Please, Christopher.
Thank you. I just wanted to know your thoughts on the following. Latin America is kind of happily divorced from a lot of the biggest geopolitical crises of the moment, doesn't really have a dog in the fight in Russia-Ukraine or in Israel-Hamas. It's also happily largely immune from threats like global Islamic terrorism, for example, or indeed global migration. And potentially, it's a beneficiary from some of these tensions in the sense that, COVID obviously showed alternative supply chains not involving China were a useful thing to have. The whole nearshoring, friendshoring thing, which several people have touched upon. But Mexico in particular, whereas Brazil, say, is a customer of China, Mexico is a rival to China. So people are turning away from China, and that's to Brazil's benefit, to Mexico's benefit. Equally, the terrible situation just a few hundred miles from here, if Russia and Ukraine are taken out of the global food supply chain, then that is potentially hugely beneficial economically for countries in Latin America. So I just wanted to know what you thought about those comments.
I think that overall, and again, I cannot speak on behalf of any of these countries, but I think that the best policy would be to try to stay, again, as neutral as possible. As you're saying, in some cases, there have been important winners because of trade diversion. In other cases, there have been some losers also in the region. I would say, again, that probably Latin America will go the same way as it has gone, and try to, as any individual country would do, try to benefit as much as possible from the situation. They are, in that sense, price takers, not very much price makers, and I think that they should maintain themselves that way. There's not much that they can do. And again, I think that the best way to go would probably be to stay as neutral as possible in all of these things. Sometimes it's not possible, but as much as it is, I think that would be the way to go. So if there are no more questions, well, thank you very much, and please, an applause for the panel members. Thank you very much.